Picture this. You're sitting in your Amsterdam office looking at your latest tax bill, and then you realize that the Dutch government is taking almost half of your money. Sounds familiar? Well, if you're a successful Dutch entrepreneur, you've probably had this exact moment a lot of times already. You've built something great, you created jobs, contributed to the society, and now you're saying enough is enough. The Dutch government takes 49.5% of your income plus wealth taxes that keep growing every single year. And you might think escaping Holland's tax system is as simple as booking a KLM flight to Dubai, but the Belastingdienst knows exactly where to look, and they are very, very good at what they do. So Dutch exit taxes can hit you with a huge tax bill on paper gains, money you haven't even seen yet. And there's something called the conserverende aanslag. Think of it as more like a tax ghost that follows you even after you leave. And if you are one of the smart entrepreneurs planning your escape from Dutch taxes, hit the subscribe button because we are about to dive deep into strategies that actually work. Let me explain how you're getting absolutely destroyed by Dutch taxes, starting with your business. So your Dutch BV faces a corporate tax rate that starts at 19% on profits up to 395,000 euros. So your Dutch BV faces a corporate tax rate that starts at 19% on profits up to 200,000 euros. And once you hit that threshold, boom, 25.8% on everything above it. But that's just the beginning. You've got payroll taxes, VAT, complications, and various other levies that push your effective rate much higher. And I had a client running a successful tech company in Amsterdam, and on paper his BV was paying 25.8% corporate tax, but when we calculated all the additional costs, payroll taxes, municipal taxes, compliance costs, his effective rate was closer to 32%. So that's a third of his business profits gone before he even thinks about paying himself, when he again is gonna pay taxes on his salary. And that's just your business. Personal taxation is where things get really ugly. The Netherlands has this beautiful system where they tax you personally on 3 different boxes of income. Box 1 is your regular income, start at 37% and goes up to 49.5, and that's nearly half of your money literally gone. Box 2 hits business owners, and if you own more than 5% of your company, dividend gets taxed by 26.9% after your company already paid corporate tax. So that's literally classic double taxation. And then the last one, box 3, the wildest one in my opinion, wealth tax. The government assumes your assets are making money and taxes you 36% on that phantom income, even if your investments did literally nothing. So you could lose money and still own wealth tax because the government assumes you may profit from it. So it's taxation on fictional income, you can say it like that. And that is exactly why many high net worth individuals are seeking Dutch wealth tax alternatives and exploring obviously how to leave the Netherlands tax system legally, of course. So let me walk you through a real scenario. You own a successful Dutch BV making, let's say, 500,000 euros annually in profit. And after corporate tax, you're left with around 400k euros. So you want to pay yourself dividends, of course. That's where you get hit with 26.9 dividend tax. So you're left roughly with 291,000 euros from your original 500k. So that's over 41% effective tax rate before wealth tax. So this is exactly why we are seeing Dutch millionaire migration accelerating very high according to recent research by CBS. This is the Dutch National Statistics Office. And it's not about avoiding responsibilities. No, it's about keeping a fair share of what you've worked to build through smart wealth preservation strategies. The government has designed the system to make leaving as expensive as possible, obviously, to keep you in the country. And they know their tax rates are driving away talent. So they have created exit taxes to squeeze you with one final time. And let me explain you exactly what could happen if you don't plan this properly. So you've built a successful e-commerce business in Amsterdam. You decided, for example, to move to Dubai, where we are. You move there, get your Emirates ID, and even start a UAE company. But you keep your Amsterdam apartment just for visits, for example. And you maintain your Dutch BV directorship because that's where your business is. And every month you fly back for business meetings, of course, that include dinner with friends and family. Well, you spent less than 90 days in the Netherlands that year. Well, you're living in Dubai, of course, but working from Dubai. And by any reasonable measure, you're a UAE resident, right? Well, wrong. The Belastingdienst, aka the tax authority in the Netherlands, will take one look at your situation and say, nee bedankt. That's no thanks in Dutch. So despite living overseas, they will classify you as a Dutch resident. So you'll be paying Dutch taxes on your global income while living in Dubai. That's why you have to move your whole center of life. And this is what I mean when I say the Belastingdienst doesn't mess around, guys. They are analyzing your entire life, your family connections, your business relationship, where your heart really is. And their investigation tactics are incredibly sophisticated, and they have access to international databases for cross-border tax planning enforcement. But that's not even the worst part, and you probably think exit taxes happen to other people. Well, let me tell you about the kostenverende aanslag. The tax trap, you might know that it even exists until it's too late. So you've built up your successful Dutch BV over the years, and maybe let's say it's worth 2 million euros on paper now. You decide to move here to Dubai because of the beautiful life we have here. And the Dutch government will hit you with a deemed dividend, and they will treat your shares as you have sold them the day before you left. So even though you haven't sold anything, you owe capital gain tax on money you've never seen. So on a sale that literally never happened. And then comes the conserverende aanslag, the protective tax assessment. So think more as it like the Dutch government putting a lien on your future. So they're saying you've built up wealth here that we haven't taxed yet, and we're not collecting it now, but we're keeping it track. And I've seen entrepreneurs get hit with 400k euro tax bills on paper wealth they've literally never touched. And this tax bill doesn't disappear. It follows you like a shadow, waiting to be collected until you ever come back or if certain conditions are triggered. And here's something that should really terrify you about timing. And maybe you're a Dutch entrepreneur or a Dutch person watching this video, and then I think that you're gonna know this. When September comes around in the Netherlands, everything changes overnight. So imagine your worst nightmare. It's the third Tuesday in September. It's called Prinsjesdag. And you're in Dubai office feeling good about your exit plan, and then you have to check the news. Government announces new anti-avoidance rule effective immediately. So your perfect legal exit strategy that you've been working on for months, for example, if you are, is now potentially taxable. And the strategy that has legal yesterday is now literally considered abuse today. So the Dutch government has this weapon called anticipatory effect, and they can make that new tax rules effective immediately before the law is even passed. And they do this specifically to prevent tax avoidance when they announce loophole structures. So the absolute worst part is, according to reports, the government has approved a new personal exit tax on personal level, and even after you successfully change your tax residency and move, for example, here to Dubai, like we did, you will still be taxed as if you were living in the Netherlands for example, 5 or to 10 years after you leave. So you could be living in Dubai, paying for housing in Dubai, building a life in Dubai, and the Dutch government will still come after you for taxes as if you never left Amsterdam or any other city in the Netherlands. So the Dutch government will change the rules mid-game to protect their tax revenue. So your window of opportunity can literally close like this overnight in one day. And with the Netherlands' high net worth exit trend accelerating according to the latest CBS data, timing is going to be now literally everything. So smart entrepreneurs are focusing on proper tax residency planning and asset protections in the Netherlands for strategies. But there are still legitimate Dutch exit tax avoidance strategies that work through proper international relocation planning. So the Netherlands has tax treaties with over 98 countries according to the Dutch Ministry of Finance. And these are legal agreements that can dramatically reduce your tax burden when you use them correctly, guys, as part of comprehensive expat tax planning services. So take the Netherlands UAE treaty, for example. According to the official treaty, text published by the Dutch government, capital gains on most assets except Dutch real estate are only taxable in your country of residence. So if you become a UAE resident, those gains could be completely tax-free. So that's very interesting. But you can't just wave a piece of paper and expect the Dutch government to say, oh, you're in the UAE resident now, right? No problem. Enjoy your tax-free life. That's not possible. You need to establish genuine tax residency. Build real substance in your new country. Get proper structuring through offshore company formation and have documentation proving your legitimate residence. So think of it like getting a driver license. You can't just claim you know how to drive. You actually have to pass the test. Your Dutch BV relocation planning is going to be maybe your biggest challenge when you try to leave the Netherlands. So your BV stays Dutch for tax purposes even after you leave. So if you're managing it from Dubai, you've created a dual resident company with tax obligations in two countries. So you'll still have director duties under Dutch law, and the Dutch authorities don't care if you're literally networking or something from a beach in Dubai. You're still legally responsible for that company in the Netherlands. So then there are the substantial shareholding rules that will affect you. According to recent guidance from the Belastingdienst, the Netherlands has specific rules for significant shareholders that create ongoing tax obligations after your departure. So what is the smart approach now? That's the first question you might have now. Well, you create proper holding structures in tax-friendly jurisdictions, you establish management protocols through international business restructuring, and you gradually transition operations while building genuine substance in your destination country. So please, guys, make sure that if you want to move your company, be aware that there's a corporate exit tax coming and that there might be in the future, and that is a huge possibility that the exit tax on a personal level will also be introduced. And if you're waiting now and you want, for example, to relocate now, you're thinking about it, that you might be too late. So for personal, change your tax residency, but make sure that your center of life is really in the UAE or any other country you'd like to relocate to. If your company, if you want to make sure that your company is taxed somewhere else, make sure that your company has proper economic substance. That's it for now. If you have any questions, feel free to drop your questions down below. I'm going to read everything. And if you'd like to schedule a meeting, also link in the description to talk about all the options you have. And I'll see you in the next video. Thank you for watching.